You think you know who owns the world's biggest brands? You're wrong. There is one company managing over $10 trillion, more than the economies of Germany and Japan combined. They're your landlord, your bank, your boss. Yet most people have never heard of BlackRock. Here's the twist. BlackRock doesn't own the assets it manages, yet the power that comes from overseeing so much wealth shapes everything from your retirement to corporate boardrooms. How did a firm most people can't name end up with influence on this scale? And who really holds the strings? Let's decode the BlackRock monopoly. BlackRock manages more money than any other company on the planet. As of September 2025, the number stands at $13.5 trillion in assets under management. That's not just a headline figure, it's a sum larger than the entire economic output of Germany and Japan combined. Imagine every dollar flowing through the world's biggest pension funds, insurance companies, governments, and millions of individual investors, all pooled together under one roof. That's the scale at play. Assets under management, or AUM, means BlackRock oversees, though doesn't own, this mountain of wealth for its clients. The company's reach touches about 18% of the world's publicly traded equities. In practical terms, that means nearly 1 out of every $5 invested in global stock markets is managed by BlackRock. The sheer size gives the firm an unmatched seat at the table in boardrooms and markets from New York to Tokyo. This isn't just about big numbers. When $640 billion in new investments flow in over a single year, every major company, government, and retirement saver feels the ripple. The company's CEO, Larry Fink, once described BlackRock's mission as helping more and more people experience financial well-being. But with such scale, the question isn't just about helping. It's about how much influence comes with managing a sum that could buy every share of Apple, Microsoft, and Google, and still have cash left over. That's the kind of weight BlackRock carries in today's financial world. Larry Fink started BlackRock in 1988 with a small team and a single obsession: never repeat the $100 million risk mistake that ended his career at First Boston. From the beginning, BlackRock was built on the promise of risk management for big institutions, pension funds, insurers, and governments needed someone to watch their backs. By 1999, BlackRock had gone public, raising capital to fuel its ambitions. The early 2000s brought a series of bold moves. In 2004, BlackRock acquired State Street Research, nudging assets over $325 billion. Just 2 years later, the firm nearly doubled in size by absorbing Merrill Lynch investment managers. But the real turning point came in 2009. BlackRock spent $13.5 billion to buy Barclays Global Investors, and with it, the iShares ETF business. That deal was not just another acquisition, it was the moment BlackRock moved from a risk-focused boutique to the world's ETF powerhouse. iShares became the engine of scale, drawing in trillions from investors who wanted to track the market instead of trying to beat it. By 2017, iShares alone accounted for $1.4 trillion in assets, and today the iShares Core S&P 500 ETF manages $300 billion by itself. Millions of investors, teachers, nurses, tech workers own a slice of the market through these funds. In practice, that means BlackRock manages 5 to 6 million shares of some of the world's biggest companies at any given time, all on behalf of clients. This quiet accumulation of influence set the stage for a new kind of power, not just holding assets, but shaping the way corporate America is governed. Every spring, tens of thousands of annual shareholder meetings unfold across corporate America. At the heart of these meetings are the votes that decide who sits on boards, how executives are paid, and what direction the company takes on everything from climate change to political spending. BlackRock's investment stewardship team reviews nearly 10,000 proposals each year, more than any other player in the industry. The company's voting power stretches across about 30% of United States equities, a scale that few outside Wall Street ever notice, but every CEO feels. For most investors, from teachers to tech workers, their 401k contributions flow into index funds. These funds hold slices of hundreds of companies, but it is BlackRock that casts the voting attached to those shares unless clients take special action. The firm's stewardship team pores over board slates, incentive plans, and climate policies, weighing how each decision affects long-term value. This is not just rubber-stamping management. In 2023 alone, BlackRock supported management on about 89% of proposals, but also pushed back on hundreds of issues, from board diversity to executive pay. The Voting Choice program was introduced to give clients more say, opening up $2.6 trillion in assets for direct voting by institutions and, in pilot form, retail investors. Still, most investors stick with BlackRock's default approach, trusting the firm's expertise to handle the complexity. As Megan Green, who once led the stewardship team, explains, the concentration of voting power is both a service and a concern. It raises questions about whether corporate democracy is truly in the hands of millions or quietly concentrated in the offices of a few asset managers. At the heart of BlackRock's power is a piece of software few outside finance have ever heard of: Aladdin. Every day, more than 30 of the world's biggest banks, insurers, and investment funds rely on Aladdin to track, analyze, and stress test their portfolios. The platform doesn't just crunch numbers for BlackRock's $13.5 trillion in client assets. It forms the backbone of a financial network managing an estimated $70 trillion globally. Aladdin's code shapes how risk is measured, how trades are made, and how entire markets respond to shocks. If a glitch or bias creeps into its models, the consequences ripple far beyond any single firm. Dr. Jeremy Siegel of Wharton points out that when so many institutions use the same risk engine, the entire system can move in lockstep, amplifying swings in good times and bad. In moments of crisis, governments have turned to BlackRock not just for advice, but for operational muscle. During the 2008 meltdown, the Federal Reserve and U.S. Treasury tapped BlackRock to help unwind $130 billion in toxic assets from Bear Stearns and AIG. The firm's expertise and Aladdin's analytics became essential tools for stabilizing markets. In 2015, as Greece teetered on the edge of default, Yanis Varoufakis, then finance minister, watched BlackRock step in to help manage 30 billion euros in distressed assets. Supporters called it a lifeline. Critics worried about handing the keys to a single private player. Each time a crisis erupts, BlackRock's reach grows deeper, raising uncomfortable questions about what happens when the world's financial plumbing depends on one company's code. Cheap index funds have saved investors an estimated $15 billion a year, thanks to average fees as low as 0.03% on BlackRock's flagship ETFs. That cost advantage has fueled the rise of passive investing, but it comes with a catch. The bigger BlackRock gets, the more critics line up from both sides of the political aisle. ESG activists like Sarah Hoffman accuse the firm of not doing enough to push companies on climate and social issues. Meanwhile, conservative analysts such as Robert L. Bradley Jr. argue that BlackRock has gone too far, using its voting power to push an agenda that doesn't reflect the wishes of everyday investors. In 2025, about 60% of ESG proposals received BlackRock's support, a number that satisfies neither camp. The FEE war keeps money flowing in, but every dollar saved intensifies the debate over who really controls the future of corporate America. 13 million American households rely on BlackRock to help manage their retirement savings. For most, the connection is invisible, a line on a 401k statement, a fund in a pension plan. But the influence reaches further. In 2025, BlackRock launched a pilot using blockchain to tokenize traditional assets, aiming to make owning and trading slices of real estate or infrastructure as simple as buying a stock. The company is also rolling out AI-powered tools that promise to automate portfolio choices, raising new questions about transparency and control. Maria Gallardo, a pension trustee, has watched these shifts reshape how retirement security is built. As regulators in Europe push forward with strict sustainability rules like SFDR, and US lawmakers prepare for a major hearing on asset manager power in 2025, the balance between innovation and oversight is entering uncharted territory. Every time you check your retirement account or see a corporate headline, BlackRock's unseen influence is there. As trillions quietly move through its hands, our markets and our choices are shaped by algorithms and proxy votes, not elections. The real question: who should steer the system? Let's hear your take below.